Hi, everyone, and welcome to the ClearBridge Large Cap Growth Update for the second quarter. As a reminder, the investment objective of ClearBridge Large Cap Growth is to construct a concentrated set of 40 to 50 names in a way that's more diversified as well as more risk-aware than the index. I'd like to introduce everyone to Peter Bourbeau, who will be entering his 30th year with ClearBridge in 2021. And Peter joined the Large Cap Growth strategy in 2004 and has been managing the portfolio alongside Margaret Vetrano since 2012. We do want this to be an interactive update, so please continue to submit questions, but we want to jump right in. And the most appropriate starting point has got to be the massive policy response that we continue to see from the Fed and Congress. So Peter, my first question is, how has the market digested the level of stimulus we've seen over the last year?
Hey, thanks, Jake, and good morning, everybody. Good afternoon. Thanks for joining today. It's pretty clear that, and hopefully everybody's got the webinar pulled up. You can get a kind of a fresh look at what the stimulus stand-up looks like relative to the last 5 recessions. It's unprecedented, right? We've never seen, and clearly, you know, the economy is much bigger today than it ever has been, but we've never seen these programs be stood up so fast and so aggressively. And again, relative to the last 5 recessions, right, we're 50% greater than the last 5 combined. Just a couple points there, right? Is I think the MVP of the last 2 years, right, has to go to Powell and Mnuchin. I think they treated COVID like it was a natural disaster, like the greatest that the world's ever seen, and not like it was the great financial crisis or any other issue that we've had in the past. And for those reasons, right, they got through huge programs through Congress and you know, more than anything, single-handedly saved the system. So I think they saw what the magnitude of the drawdown could look like, and they got programs through quickly. Now, I would say that you've clearly pulled forward an awful lot of good news. I'm not suggesting necessarily good news on the economic front, right? But when you throw that much product at the system, and the product being money, you've supported the system, but you've also de-risked it, right? I think the message is that we've got this, right? You know, in quotations, and if you look at the various forms of potential stress in capital markets, you see nothing, right? You see nothing that's alarming, right? Credit spreads are intact. The VIX measuring volatility in the equity markets, credit default swaps, put call ratios, hedging, with maybe a few pockets of stress, but virtually nothing screams nervousness, and that's, you know, oftentimes not a great place to be. Right, and I think it's pretty clear that we're relying on the Fed and the Treasury to really engineer this recovery over the next 2 years, which, you know, we're giving these guys an awful lot of credit, right? He's got almost a cult-like status, and he, I guess, deserves it. But he's got a huge job over the next 2 years. But just to kind of finish that thought, right? The numbers are unlike anything that we've seen, and I think that just bears repeating that this will eventually wear off, and price disclosure will find its way into the capital markets. Right, we're kind of artificially keeping rates low. We've pulled forward, you know, retail sales. Maybe there's some pockets of inflation, which I know we're going to talk about, that is a result of aggressive monetary policy, but you know, we've stood up big programs, and those will naturally ebb over time. So, Jake, let me throw it back to you.
Thanks, Peter. So part of your comments is that accommodative Fed policy will keep shorter duration tethered pretty close to zero. How do you think that the market could react if we see continued steepening of the yield curve?
At some point, he's going to have to address that. The practitioners that I listen to in fixed income are suggesting that by the summertime we might start hearing some of the Fed governors or even Powell himself just start talking loosely about removing some of the stimulus from a QE perspective, right? I think the risk-free rate will continue to be anchored, but the first thing to go, right, is going to be the massive bond buying and the growth of the balance sheet from the Fed's perspective, right? Because keep in mind that the Treasury issues bonds to pay the bills, and the Fed is buying roughly 70% of them right now. That's unsustainable. And I think that for the purposes of the Fed managing for long term, they've got to start walking people back, and he's going to do it delicately. But we've seen taper tantrums before, right? We saw this kind of inflationary pressure at the end of February that kind of wrecked some of the tech areas. So he's got to engineer something that has never really been done before, and so everybody's going to be kind of hanging on his last word. If you look at the chart that you're showing, Jake, today, this is completely normal, right, at this part of the cycle, right? If I was taught kind of early in my career that rates go up, not the managed low end, but the market participant rates of 10, 20, and 30 year rates go up for three reasons, right? Number one is a meltdown in the dollar, right? It's weak, but that's not really a concern right now. The other is higher inflation, and I think it's very clear that we're going to have some mega headline numbers that we're going to have to deal with. And then lastly is economic growth, right? 2 out of the 3 aren't so bad. They're not bad for corporate earnings, right? They're not bad for economic growth. They might be bad for PE multiples, but we're gonna get to that. But 2 out of the 3 reasons that rates are going up are actually pretty positive. All of those areas that have rate sensitivity, banks and Schwab and so forth of the world have responded accordingly, right? Which is 100% natural. But we see much higher rates. The bond vigilantes, which is a term that's thrown around a lot. They're going to take over at some point, probably summertime, and I think we're going to see the 10-year certainly well above 2 and maybe approaching kind of 2.5 as we go into the end of the year. We'll see how the market reacts. Oftentimes it's going to be out of the Fed's control, but this is going to be just an interesting balancing act. But again, if you look at this chart and look at where we are, we've got more to go, and it's perfectly natural when you kind of look at past recoveries.
On the topic of on multiple compression in the face of rising rates, we actually found that monthly or quarterly returns, they don't do a good job of capturing defense in the portfolio. And that's just really a function of how quickly pockets of volatility have passed over the last year. But when we break down the performance of large cap growth to daily returns, we found that our 1-year down capture was 89. And so we have been pleased with this defensive posturing in the face of multiple compression and rising rates. And that's not only relative to our benchmark, but also versus our peer group, which we found was in the mid-90s. So we picked up almost 1.5% of relative ground during the volatility in March. And over 100% of that outperformance, it was on the down days. So, right. Peter, why did the portfolio hold up better than the index in the face of rising rates?
Yeah, it's a good question, Jake. A couple of reasons. Number one is, commensurate with that rate taper tantrum, whatever you want to call it, late February. A lot of the winners through that part of the cycle were reopening stocks, right? So things like Advance Auto and Home Depot, Uber, UPS had good kind of total returns during that period. And then obviously on the flip side, with rates moving higher, it's the most expensive arm of the most expensive subsegment, right, within technology, right? Whether it's unprofitable tech or even kind of small cap value, guys that are kind of living way out on the whip and really need interest rates or low rates, I should say, to make your DCF work. So we kind of caught it two ways. Balance has been kind of a dirty word for the last 2 years when you think about portfolio construction, right? This market has literally been up and to the right, not necessarily because of operating results, but really, strictly in terms of how we look at it through multiple expansion, price to sales, price to cash flow, whatever you want to use. I think we're finding some better distribution in returns, some normalcy in leadership. And again, back to that point on yield curve, totally natural as we kind of think about where we are in the cycle. I know we're going to get to it, Jake, but if you look at the sheer size of technology in the Russell 1000 growth, it's orders of magnitude larger than we've ever been. But just going back to that chart, I think it's page 5. Yeah, right there, Jake. We're back to this inflation question and just our view, and this is anecdotal, right? This is us just trying to connect the dots. We're in the middle of earnings season, and we're paying attention to what CEOs and CFOs are telling us. And I mentioned this before. The Fed is going to have to deal with white hot inflation readings across the board, right? And it doesn't take a genius, right, to realize what's going on. There's not a single pocket that we're looking at that doesn't have inflationary pressure heading in its direction, right? You see, base metals, whether it's copper or iron, or you look at lumber, a 4 foot by 8 foot piece of plywood, went from $12 to 40, right, in the course of a year. Every raw input into food, right? So think about all agricultural commodities: corn, soy, wheat, making secular highs. Housing, and the term that the Fed likes to use, the owner's equivalent rent, right? I don't know if you guys saw the housing numbers from this morning. It's also running white hot, right? Up 12% in February. That's a year-on-year number, and then January was revised up to 12% as well. So housing continues to be on fire. Look at autos, right? The widely tracked Manheim Index for used cars is up 50%, right? 50, a year-on-year basis, right? New cars, there's some pricing power because there's no dealer inventory. And then lastly, and potentially the most critical element of inflation is going to be labor. And if you think about reopening and the service sector generally speaking, it's hard to find bodies to go back to restaurants and bars. The one critical element I've got with the amount of Fed stimulus, right, is you're paying people not to work. That will end, right? People got a decent dose of socialism and they like it, but to get this economy back to a working state, right, you've got to get people back into the private sector. You have 17 million people still claiming continuous claims, and that can't continue, right? That's got to end. If you look at the payrolls report and initial jobless claims, you're making cycle lows, right? Pandemic cycle lows, which is good, right? But you got to get people off the government payroll, because currently the U.S. government, through transfer payments, is responsible for 30% of personal income. 30%, which is an enormous number. So the competition for labor is high. So you add that element in as well, and that's gonna add another element that the Fed's gonna have to watch. The thing, and just to kind of pull this thing full circle, for the first time in 20 years, right, you're finding companies that have legitimate pricing power. It's expected. We spent a lot of time really listening to the CFOs about how they're going to manage through this, and it's amazing how accepted price increases are. There's the ex-CFO of Home Depot, who's the new CEO of UPS. We listened to Carol this morning, and she's talking about pricing per parcel, pricing per lanes shipped, right? So from Asia and Europe, and she's pulling through gargantuan pricing power, and this is a pass-through, right? So this will hit reported CPI and PPI numbers eventually. Semiconductors, right? Because of the shortage, right? You're seeing huge pressure on prices higher. Hard lines, right? Home Depot and Tractor Supply and Grainger and Advance Auto are going to be pushing through mega increases as well. And then airlines, right, and accommodations, you're back to kind of pre-pandemic in terms of as you bring back capacity in terms of hospitality and airlines. So it just putting it all together, right? I think it's going to be very interesting to see how the market responds to pretty hot inflation numbers that'll be printed in the summer and early fall.
Thanks, Peter. I appreciate your comments about how inflation accompanies economic growth, which is net a positive, and certainly how that can create investment opportunities for you and Margaret. To take the conversation back to tech a little bit, I do want to talk about how you took advantage of the volatility during the first quarter. So are there positions within tech and internet that you use that volatility to tactically add to?
We've got quite a few. We've been and those of you that are watching us on the SMA side that see the trades, we've been pretty busy over the last six months. A couple new positions. Atlassian, which is a Sydney-based company for workflow and DevOps. It's just a really unique company that helps processes through internal supply chain get done. It's unique. They've got a leadership position that was I guess initiated in the fourth quarter, added to in the first. Workday is not a new enterprise software name, but what's different about it is they're really embarking on a new vertical in financial services that they haven't really played in before. So the kind of human capital management, HR vertical of Workday's been pretty popular. I think we've all kind of converted at the enterprise, but the financial services vertical is new. Another new name, C Limited. This might be new to many of you. This is a Singapore-based e-com company that has huge exposure in places like Taiwan, Indonesia, Malaysia, Philippines, now in LATAM. They're standing up a new offering in Brazil. So it's e-com. Gaming right now pays the bills, right? So they're running e-com at a loss. It's going to be a marketplace, right? So it's not going to be like Amazon necessarily that carries first-party merchandise. It's going to be more of a marketplace. But they're seeding the market, helping the sellers stand up their offering. So this is just a really unique company. We know obviously the e-com space well with investments in Alibaba and Amazon for the last 18 years. This is just a pretty unique company, and we try to take advantage of some of the weakness there. We've added to our Uber, which is a kind of a reopening play. Salesforce, which has been a disaster after they bought Slack. So added to that one. Facebook, as they lap pretty easy comps over the next couple of quarters. Palo Alto Network in security. Amazon we've added to, and probably will add to that one again, and Grainger. And oddly, Grainger is an MRO, but they've got a top 10 e-com site in terms of total sales in the U.S. So it's not widely appreciated, but that's for selling tools and safety equipment. They've done an unbelievable job of standing up a huge online offering. So we've been busy, right? The thing that we need to be aware of, we alluded to it before, is if you kind of aggregate tech as we see it, and then throw in things like Amazon, Facebook, Alphabet, Tesla, those kinds of names, you're at 67% tech or tech-like in the benchmark. Also an unprecedented number. Right, I was back to that earlier comment. The only thing that mattered in the last 2 years is how you've been positioned in tech. Right, you can kind of see that with that chart on the left, but nothing else has frankly mattered as far as performance goes. And that's the kind of positioning and scenario that should make kind of the hair on the back of your neck stand up, right? Because we are mega concentrated in things like tech. The index has become certainly, but looking at the chart on the right, even more concentrated. Now, to give tech full credit, right, this is where earnings growth has come from. This is where innovation and leadership have come from. These are dominant franchises that have huge global influence. But there's also kind of limits in that regard, right? The price movement for the most part has been about multiples, right? Not about necessarily earnings growth. So again, another thing to think about when you start removing liquidity at the Fed level as well as rates going higher. It's extremely sensitive because these are the open-ended names within the space, right, that are massively reliant on low rates to make your DCF, right, your discounted cash flow, work. So we're looking at tech a little bit differently than we have in the past. We're looking at platform companies and looking out, frankly, 3 to 5 years, right? There's positions that we know will be down 20 to 30% if rates kind of do what we think they're going to do, and we just need to be ready to add to them if we're satisfied with the kind of the operating results. But the call here is that it's not going to necessarily trade like a monolith anymore, that being tech, and you need to get a little bit more selective. You need to think out a couple years, and the idea is that all ships won't rise with just the general level, and I think you really need to be very focused on those platform companies that you want to own for the next 3 to 5 years. So that's what we've been trying to do. We're going to continue to refine that, and so you should see some additional activity. If we do see some drawdowns, you'll see us pivot even more.
Thanks, Peter. And not surprisingly, this slide has sparked a number of questions from the audience on regulation. So what do you think are some of the risks that are in the tech group, and how would you expect the portfolio to hold up if any of those risks start to materialize?
Yeah, we saw that in February. A couple points, right? Rates, I think, are going to be very impactful, and so we have a belief, right? On it's certainly not hardened, but with rates and inflation doing what we think they're going to do, right? You might see another drawdown, which is fine, healthy, and kind of expected. You have just gravity, right? Just the sheer size of some of the market cap relative to future growth rates are also getting called into question, right? You've got certain names that are characterized as tech that frankly aren't, right? There's a notable car company that will remain anonymous that comes to mind. We have the other specter of regulation, right? Now, most of our portfolio companies, right, they aren't new to challenges from various regulatory bodies globally, and they've managed through quite well, I would say. But that's the other thing, right? We've got the head of the DOJ and the antitrust arm are in a kind way they're anti-big tech, and so you can expect the rhetoric to increase over the next 3 to 6 months. It's not clear if there's a case, right? But you will expect increased activity from the regulatory perspective. Now, again, most of our companies have been in some form of litigation globally for decades, and they know how to manage through it, and they know the process pretty well. But headline risk, I think, is going to be pretty abundant for the next 3 to 6 months.
To transition here away from an underweight in the portfolio to an area that you're overweight, I do want to talk about why consumer is a focus area for you and Margaret, and where within consumer are you generating some new ideas?
Yeah, this is a great chart, and I say that because the consumer has acted very differently this recession than previous recessions. Now, clearly, as I mentioned, the federal government and transfer payments are responsible for 30% of personal income, which certainly helps. But consumers behaved differently in that they actually paid down revolving credit card debt. The credit quality is oddly spectacular at this point of a cycle, right? We've lapped all the major banks and credit card companies in terms of earnings, and the reserve releases have been huge, right? And which we've all witnessed. The credit quality, delinquencies, and charge-offs have been amazing. So people took their stimulus and certainly spent some of it, but not all of it. And what they didn't spend on disposable, they spent on paying down debt, or at least maintaining their credit, which is, again, very atypical But again, it goes to show you just the sheer magnitude of the money that was sloshing around. It had to go somewhere. So that was a very good result, right, of a ginormous gift. Now you can kind of think about going fast forward and what this means. Nesting has clearly been a beneficiary, right? If you look at boats, right, and RVs, the do-it-yourself category, with the Lowe's and the Home Depots of the world, small farms, all of that with tractor. I mean, the comps in the nesting category are still spectacular and probably will be for a period of time. You get that analogy, which I think we've all heard. Are we back to the roaring 20s once we fully open up? I don't know. I can tell you that the pent-up demand, and you guys see this as well, is extraordinary. And you look at the advanced bookings and airlines and Airbnbs and general hospitality. This is going to be an interesting kind of second half of the year if trends hold. But you will see this money get released, back into the system. There will be a level of austerity. There kind of is after every recession, but there's just an awful lot of money that can get repurposed right into experiences and so forth. And again, another reason why the leadership broadening out and the reopening trade, I think, has significant legs. It's probably the only group that we're looking at that is mismodeled. And when I say mismodeled, I'm talking about consensus from Wall Street is probably wrong, right? You look at things like advanced auto that blew out numbers and has a really robust 3-year plan going forward. Tractor supply, right, which was one of those where could they comp the comp, right? I mean, I think they had like a 25 or 28% full year comp. They just raised guidance to 6 to 8% and probably will raise it again this year. So they are a unique company that is comping the comp. And these trends are certainly in place and will be for a period of time. So we've got exposure in the fund. We have Booking. Visa, oddly, is a consumer name, and largely because of the cross-border. So if you think about Europe travel opening up and the way that they process the high-margin cross-border transactions. Home Depot, clearly, Tractor Supply mentioned that's successfully comping the comp. Ulta, it's just such a massive category in beauty and skincare. Uber is part of the reopening consumer trade as well. Mobility is finally showing signs of life. You've had, between Lyft and Uber, you've had the best week of any in the last 14 months. Budweiser could certainly use some help with on-premise consumption, and that should be opening up as well. So we've got solid consumer exposure here, and you potentially might see some more.
Another overweight that you have in the portfolio is in semis. So I wanted to get your outlook for the space and also talk about which individual assets are in the portfolio.
Yeah, so if you look at kind of the tech meltdown in, I guess, late February, oddly, semis performed very well. So the expensive arm of the unprofitable kind of software companies got lit up. But semis did well, and part of the reason why our semis are tied to economic growth more so than kind of open-ended software. So what this chart is telling you is we're in an area where there's a kind of a disconnect between supply and demand. Demand is still extremely strong. We have a portfolio company, NXP, that reported this morning, and if you listen to it's a Dutch-based company with huge operations in the United States. They've got massive front-facing offering in autos. So if you think about the digitization of autos, this is almost a pure play in terms of content going higher. But they've got great visibility into some of their leading OEM customers, and we know that there's a supply shortage, right? There's a couple unique things that have happened probably in the last 5 to 10 years. within semiconductors, right? Number one is the industry has become massively consolidated, right? If you think about the number of names today versus 10 years ago, right, we have just a third of the names, right? So you've had massive consolidation in semis, and for those reasons, these guys are better operators, right? They've got greater visibility into the end markets. I'm not saying they don't fall, they don't fall short sometimes when you look at double ordering and all that, but it's for the most part better managed companies. You've got different growth drivers, right? This isn't necessarily about memory. Think about DRAM and all of those kind of historical kind of legacy issues with PCs and logic chips and all that. This is totally different, right? With data centers, artificial intelligence, natural language processing, which is a giant, consumer of processing. Autos, as I mentioned, new car coming off the assembly line has got between 5 and 10 times the content as an auto just 5 years ago. Moore's law is over. I think everybody is familiar with that term, where you're doubling the compute power every year and then cutting price in half. That's effectively over. It no longer exists just because of the density of transistors and limitations with line widths and so forth. I mean, we're to the point now where advanced computing, right? So think about GPUs like NVIDIA and AMD's offering is the new generation of compute, and it will be really, if you look at all applications written today, they're not on logic chips, right? They're on some version of advanced computing. Just the computational horsepower is infinitely higher with a setup like that. And the last thing though is the critical manufacturing of components is almost monopolistic, right? We have a company, ASML, and they've got a product called EUV, which is so critical in the manufacturing process, and they've got massive pricing power, right? It's one of the weird companies that can double earnings and then double them again all in the course of the next five years. It's super unique, and you've really got three customers, right? You've got TSM, right, or TSMC, Taiwan Semi. You've got Samsung, and then you've got, even as wobbled as Intel, right? They're still a giant manufacturing hub as well. So you've got three customers, right? So you've consolidated the kind of the global manufacturing. And so, and sorry, it's a long way of answering your question, but we're well aware that the group works in cycles, and we're paying attention closely. But if we kind of connect the dots of what Qualcomm has told us with not just 5G, but some more of their advanced sockets and RF and millimeter wave and a lot of technologies that will be with us for a period of time. NXP this morning, ASML from last week, they reported and guided, and then NVIDIA, which rolled out kind of a 3 to 5 year game plan, which is it's amazing. It's amazing what they're working on, and it's just amazing how critical they are really to all advanced technology. So we've got good exposure in semis. We're certainly well aware that the cycle can turn quickly, but feel pretty good about what we own today.
Thanks, Peter. I do want to briefly address a common question that's been coming in, and that's about growth versus value. So the way we think about it and the way we look to create value is through stock selection and style purity. So that involves taking advantage of low valuation to create an opportunistic entry point, but that's going to be in a company we believe is going to improve cash flows and returns over the next 3 to 5 years, an improving fundamental story. So these opportunistic stocks, they are different from value stocks, but they do clearly differentiate us from other growth managers that are out there. And I think maintaining exposure to these companies that have revenues or profits that are depressed for fixable reasons, that's what allows us to own some names that are directly leveraged to the recovery. So this is more about positioning for the reopening than a growth versus value shift. So Peter, on that topic, I do want to ask which other exposures in the portfolio are directly leveraged to the reopening? I know we've covered a lot of ground already, but where else do you have recovery plays?
Yeah, I mentioned a few kind of in this slide. We throw a couple down there. ASML, as I mentioned, only because of the kind of monopolistic nature of their product set. Qualcomm, which is operating off a lower level, we should see peak earnings 50% higher than they are today. Alcon, a name I think we've discussed on these calls before, right, could certainly use the help of having more capacity in hospitals and ASCs for cataract surgery. Confidence in people going back to see their ophthalmologist for fittings and so forth, for contact lenses and glasses. These guys are pure play, right, in that space. So a couple that we highlighted there. I mentioned things like Uber, right, and if you think about mobility, right, they've got two businesses, right. They've got delivery, which is food and other, and they've got mobility, which is the kind of the standard ride share. And if you look at the volumes, right, you're certainly well off COVID or pre-COVID, but you've had some of the best weeks as things have opened up in the past. So the incentives are there to keep drivers working. They pulled forward their plan on EBIT break even. So in terms of things that they can control, the CEO and CFO and two individuals that we know very well from a previous life, they've done an amazing job at managing the business. You look at something like an Ecolabs, which reported this morning kind of a softish number, and this is a company that produces huge amounts of water chemistry and sanitation to hospitality, right? So if you think about the Burger Kings and the Marriott hotels, along with food and beverage and other things, warewashing and for dishwashers in general purpose. It's a company that has effectively had a third of their business go to zero, but that's a great play on reopening as well. Budweiser has been mentioned. Disney, hopefully for the reasons we're aware of, right? Whether it's their theme parks, which I think are going to surprise to the upside this calendar year, back to that idea of pent-up demand, as well as cruise ships if they ever sail again. Fidelity National, another company that's tied to reopening, right? These guys deal with merchant acquisition as well as the banking channel, kind of a technology offering within the banking channel. Visa mentioned in terms of cross-border, which is a huge profit driver for the company. Regular debit and credit swipes are good, but cross-border is great. Grainger, another company I mentioned from an e-com perspective, but they've been a huge provider of safety equipment. Think about PP&E to their customers, which is low margin, and now you're switching to kind of the core business, right? So you're selling regular stuff to your regular customers, right? So think about manufacturing and hospitality, hotels and so forth. You'll have a nice uplift, and they've got pricing power as well. Raytheon, which is the aerospace and defense company that reported earnings this morning, right? Here we need flight cycles, right? In commercial aero, it's not necessarily miles flown or flight hours. You want cycles, right? You want takeoff and landings that put wear and tear on components, and you're kind of finally getting that. So that's part of the reopening as well. And then just a couple of the retail, right? Tractor Supply, which again continues to out execute, and then Ulta, which is just too big a category to ignore. They've just really done a great job, and department stores will be shutting down in mass, never coming back. A great share taker for a long period of time. So that there's a couple areas that should do reasonably well in the recovery. I just do want to just touch on one more topic, and if you kind of look at this chart here, which is one that we've been using for a period of time, right? This product and this style of management has done well through the cycles, right? This is kind of looking for kind of a through cycle total return where you're still at a relatively low growth rate in terms of the global economy. Nothing has changed from the way Margaret and I are thinking about this, right? The stimulus, you're pulling forward some astronomically large numbers, right? But the kind of my new concern today is that we're at peak everything, right? We're at peak liquidity, we're at peak GDP, right? And if you kind of think that the the equities are anticipatory looking, which they are, right? The double derivative of everything is going to start rolling over, right? Which is the fancy way of saying the change of the change, right? We're not going to see 8% GDP in any quarter, right? Probably ever again, is my point, right? And if you kind of look at where the broader economists are thinking, right, by the second half of next year, we're going to be back to sub 2% GDP growth, right? So again, the stimulus has been amazing. It's pulled forward an awful lot, but on a normalized basis, right, a style that kind of looks across the cycle and has balance, right, should do well. It's the market that we've done the best in over the last kind of 12 years. So that was kind of a shameless plug, but we are not going to be changing kind of the way that Margaret and I approach portfolio construction or the market. We're making some tweaks at the edges, but this framework will continue as you kind of look through the next 18 months to 2 years.
Thanks, Peter. I want to quickly confirm a question we received from the audience about our overweight in consumer, and that, yes, in fact, is in that discretionary group, as you can see on this slide. But Peter, you mentioned Alcon within the healthcare group, and also we recently had Alexion acquired out of the portfolio. Within healthcare, what are you focusing on right now? Where are you looking for some new opportunities?
Yeah, it's a good question. It's probably a group that has been cast to the wolves to some extent, right? You have some potential regulatory issues, right? You've got a lot of bills to pay, and pharma has been a lightning rod. We don't own much biopharma at all. We own a little bit of Amgen and some BioMarin. These are kind of smallish positions. As we kind of think about where we want to invest in the future, and remember, it's a pretty broad healthcare portfolio, right? We own things like Zoetis and animal health. We own Thermo Fisher, which has really been an outstanding performer. We own United Healthcare, which is at the tip of the spear in terms of kind of managing the cost curve lower. And there are a couple opportunities. Alcon I mentioned as well, which should be a natural beneficiary of the opening up process. But there's this consumerization of tech within healthcare that I think is going to be with us for a period of time, right? There's price discovery, right? So people can kind of shop their procedures. There's telemedicine, which is, I think, in its early days. There's things like robotic surgery, whether it's for kind of knee replacements or soft tissue that we've done a lot of work on. And then just the idea that doctors are going to have their incentives change, right? In the old world, it was fee for service, right? Which means you could order 12 MRIs, right? It didn't even matter, right? The idea is that you didn't have any records, and doctors just need to see as many patients. That's just the way the insurance system was set up. I think what you're seeing and what United Healthcare is doing more specifically, you're bringing in doctors away from private practice, making them employees of either a hospital or the HMO, and eventually changing the incentives, right? Taking away fee for service, and it's going to be much more fee for care, which is kind of the capitated program. It's better for the patient, it's going to be better for the doctor, and it's better for the system as a whole. So these are generational changes that are going to happen in healthcare, and I think there's a lot of potential in some of the assets that we've outlined. But there's more to go. There's a lot of interest here from Margaret and I, and we're stay tuned. We've got a lot more to do.
Thanks, Peter. We've got a few questions from the audience here. I'll address the first one very quickly. So on a previous slide, we looked at the sum of GIC sector tech plus Amazon, Google, and Netflix in communication services, as well as Amazon and Tesla in consumer discretionary. I apologize if I misspoke. It's going to be Facebook, Google, and Netflix in the communication services group.
Right.
So that total is 65% of the index at this point. And the question that came in is how underweight are we tech or tech-related companies? And we're about 10% underweight. It's about 55% of the portfolio. The other questions that we've received from the audience have been about oil and interest rates. So Peter, how do you think about managing these factor exposures in the portfolio? And what is your outlook for energy and financials?
I don't have a great view on energy. The only thing I would say, and most of you guys know that at one point we owned Schlumberger and we owned Pioneer Natural, is a sea change in how energy companies are thinking about their future, right? Kind of back in the old days, the incentive was just to pull out as many barrels out of the ground as they possibly could. They'd find a willing buyer, and then hopefully they'd get purchased, right, at some point in the cycle by a major. That has gone away. I think the energy companies, for the most part, understand their mortality. They understand, capital structure probably better than they ever have because they've been forced to. And I think you've seen a lot more discipline, right? So the incentive isn't just production for production's sake, right? It's profitable production. So to me, it just seems like, I don't know if we've seen the lows in energy. I think they're going to manage supply, they being, the majors and the E&Ps, a heck of a lot better than they ever have, right? Because they've got this new focus on discipline and cash flow, and that never existed, right, in the space. So you can make the argument, right, that energy, probably won't test the lows. It'll just be managed, slightly higher, right? If you look at Aramco and the Saudis, generally speaking, I think they generally agree with this philosophy as well. And I think everyone is also understanding that we're, a couple years away, if we haven't already seen it, in terms of peak demand, right? EVs, whether you choose to accept this or not, are going to be 30%, right, of all production in 2030. And now that's only 6% of the car park, right? I mean, there's still going to be a heck of a lot of cars burning fossil fuels, but new autos, right, in 2030 will be probably 30% EV, and that's peak oil demand from a transportation fuel. So, again, I don't know if I'm answering the question. Companies have changed the way that they're thinking about managing their individual businesses, and they're not cowboys necessarily anymore that just want to produce. I'm sorry, Jake, you had another question, non-energy related.
It was on financials and your outlook for that space as well.
Fintech to us is still early days, right? The Squares, the PayPals. We own PayPal for many years. These are fascinating assets. Visa, you can almost argue, and MasterCard, still early days. So areas kind of within fintech. I think that even Jamie Dimon said that fintech is and kind of big tech, generally speaking, in terms of how they incorporate fintech, will be our largest competitor on a go-forward basis, right? You look at the Anthony Noto's model with SoFi. It's fascinating, right? And I don't want to highlight Robinhood because that's kind of a weird model, but the kind of the democratization of fintech, I think, is going to be with us for a long period of time. New models are getting kind of created daily. You'll see, I think, heavy acquisition activity in these areas, DOJ permitting. We don't have much interest in kind of traditional banks, whether it's commercial or investment banks. It's just kind of not what we do. But areas within fintech, we've got a lot of interest in, and we're probably under indexed there. We can probably do a better job, but that's an area right for underbanked and kind of global remittance and transactions. There's some really neat stuff going on. Even things like what Facebook and how they're approaching money transfer and fintech. I think it's early days, but they might be cracking the code on some things here. So so we've got exposure, explicit or implicit, and you could probably expect us to increase that if we see opportunity.
Thanks, Peter. So we'll go ahead and wrap the call there. As a reminder for everyone on the line, ClearBridge Large Cap Growth is a concentrated set of 40 to 50 names that is intended to serve as an all-weather growth strategy. So the portfolio is not only concentrated, but it's also diversified and risk-aware. We do lay out 3 distinct performance expectations. We may lag in a high beta, momentum-driven market, and that's because we want to perform well in a low-growth environment and certainly protect capital and volatility. And since our risk budget is almost entirely stock selection, we believe large cap growth is a tremendous complement to any allocation over the long term. So thank you everyone for joining the ClearBridge Large Cap Growth Update. Please don't hesitate to reach out to your ClearBridge or Franklin Templeton contacts with any follow-up questions you may have.